So um, what actually happens when a company that has lost money for, I think it's 22 out of its 24 years of existence, suddenly becomes the single most valuable public entity on Earth?
It definitely breaks a lot of traditional financial models, that's for sure.
We are unpacking an event today that is actively rewriting the rules of modern finance for you. SpaceX has, well, they've just pulled off the largest IPO in history.
Right, raising a staggering $75 billion.
Exactly. Debuting at a $1.75 trillion valuation and then just almost instantly blasting past a $2 trillion market cap. So we're staring at this massive stack of S1 filings, bank projections, and market analyses today with one critical mission for you.
Which is figuring out if this price tag makes any sense at all.
Right. We need to know if this $2 trillion valuation is a totally justified bet on the future infrastructure of the global economy, or, if we're basically watching the inflation of a historically unprecedented speculative bubble.
And I think to answer that, the tension really comes down to the stark contrast between the narrative Wall Street is buying into and the actual earthly numbers that are currently sitting on their balance sheet.
Because looking at the financials from the S1 filing, you just immediately see the disconnect.
Oh, absolutely.
I mean, SpaceX generated $18.67 billion in revenue in 2025. And on the surface, that sounds like this massive commercial success,
Yep,
right?
until you read, a few lines further down.
Exactly. And you see they posted a net loss of $4.9 billion for the year. And according to Seeking Alpha, this is a company that has basically bled cash almost every single year it's existed.
Yeah, 22 out of 24 years. It's really hard to understate how wild that is for a $2 trillion company.
I really want to dig into how the market is pricing those losses, because the multiples here are just genuinely staggering. Following the IPO, SpaceX is trading at roughly 112 times its 2025 revenue.
Which is a completely astronomical multiple.
Right, let's just contextualize that for a second. If you look at NVIDIA, which is arguably the poster child for the whole massive tech and AI boom over the last few years, they trade at a price-to-earnings ratio of roughly 31 times. Apple is sitting around 35 times.
Right, but those are price-to-earnings multiples?
Yes, those companies are generating billions in actual bottom-line profit.
No.
SpaceX is trading at 112 times its sales while operating at a multi-billion-dollar loss.
Mm-hmm.
So how does the architecture of the stock market even support a valuation like that without the foundation of current profitability?
Well, it fundamentally changes who is actually capable of buying the stock. I mean, traditional value investors and these massive institutional funds, they look at a 112x price-to-sales ratio, and they just run the other way.
I would assume so, yeah.
But more importantly, the lack of profitability locks SpaceX out of the most powerful structural support mechanism in the entire market, which is the major indices.
Like the S&P 500.
Exactly. Take the S&P 500. It operates essentially like a highly exclusive club with a very strict bouncer. The rule to get past the velvet rope is that a company must report 4 consecutive quarters of GAAP profitability.
And getting past that bouncer, it isn't just about prestige, right? It physically changes the mechanics of who is buying your shares.
Drastically. Once a company is admitted into the S&P 500, trillions of dollars in passive index funds are structurally forced to buy the stock.
They literally have no choice.
Right. The algorithms don't care about price-to-sales ratios or cash burn. Their charter dictates they must blindly mirror the index. And that creates an incredibly strong foundational buying floor.
But because SpaceX hasn't unlocked that profitability gate yet, all those passive index funds are just standing on the sidelines.
Exactly. The company is relying entirely on active retail and institutional buyers who are, intentionally choosing to overlook the current cash burn.
Okay, let me try to put this into an analogy to see if I'm tracking this math. It's basically like buying your neighborhood lemonade stand for $11,200 when it only makes $100 a year in sales.
Yeah, that's the 112x multiple.
Right. And not only does it only make $100 in sales, it's actually losing money overall to operate. How does Wall Street possibly justify paying this massive premium?
Because they aren't pricing the company based on what it is today. They are pricing in the belief that SpaceX is transitioning from a transportation company into basically the foundational infrastructure layer of the future economy.
Okay, the infrastructure layer. What does that actually look like in dollars?
Well, Morgan Stanley recently circulated a projection to their top-tier investors that models this out. They estimate SpaceX's revenue could reach an unfathomable $3.4 trillion by the year 2040.
Oh, wow.
Yeah, with adjusted earnings, so EBITDA of $2.7 trillion.
I have to pause on those numbers. $3.4 trillion in revenue.
It's massive.
That isn't a company just growing its market share. That is a company attempting to absorb a measurable percentage of the total U.S. gross domestic product. You don't hit numbers like that just by launching weather satellites or, sending astronauts to the space station.
You definitely don't. And this is where the recent merger with Elon Musk's XAI comes into play, which is arguably the core engine driving this whole $2 trillion valuation.
Right, the AI connection.
Yeah, roughly 90% of this projected future value is tied to artificial intelligence. The ambitious plan outlined in the filings is the deployment of what they call orbital AI data centers.
Putting massive computing clusters in space.
Yeah.
Which, the initial logic makes sense on the surface, right?
Mm-hmm.
Because terrestrial data centers are currently facing a massive bottleneck when it comes to the power grid.
Oh, totally. They consume so much electricity that they're literally competing with small cities for resources right now.
Exactly. So you put them in orbit, cover them in solar panels, and you essentially have access to infinite, unfiltered solar energy.
Right. And that is the power side of the equation, which Wall Street absolutely loves. Goldman Sachs projects this AI unit alone could contribute $322 billion in revenue by 2030.
Which is huge.
It is. Morgan Stanley is slightly more conservative, putting it at about $190 billion. But there is a massive engineering mechanism that these financial models often gloss over.
The catch.
Yeah, the catch. It's something deeply embedded in the physics of space. You mentioned the terrestrial constraint of power grids. Well, the other terrestrial constraint for data centers is cooling.
Oh, because when you pack tens of thousands of GPUs into a server farm, they generate enough heat to literally melt themselves.
Right. On Earth, we pump massive amounts of chilled water and conditioned air through the server racks just to pull that heat away.
But wait, space is incredibly cold, right? The ambient temperature is near absolute zero, so wouldn't an orbital data center essentially be sitting in the ultimate infinite freezer?
It's incredibly counterintuitive, but no. Space isn't cold in the way a refrigerator is cold. Because space is a vacuum, there are very few molecules to actually transfer the heat to.
Okay, so how does it work?
Think about how a high-end thermos works. It keeps your coffee hot all day by suspending the inner liquid container inside a vacuum layer. Heat cannot conduct or convect across a vacuum.
Wait, really?
Yeah.
Yeah.
It can only radiate away, which is an incredibly slow and inefficient process.
Oh, wow. So an orbital data center isn't sitting in a freezer. It's essentially trapped inside a giant thermos.
Precisely. If you fire up a massive cluster of AI processors in orbit, dissipating that heat without the benefit of terrestrial air or water is an unprecedented engineering nightmare.
I hadn't even thought of that.
You would need sprawling, massive thermal radiators to shed the heat into the vacuum of space, which dramatically increases the weight and the complexity of the satellite.
So this is why the financial projections are so polarizing. Wall Street is modeling the revenue, but the actual execution requires overcoming physics problems that humanity has never really solved at this scale.
Exactly.
And that engineering reality, it casts a very different shadow over the financial forecasts. Elon Musk went on X recently and boldly predicted SpaceX would hit $1 trillion in revenue by 2030.
Right, which is a very aggressive timeline.
Very. And seeing the gap between the physics and the hype, it makes me look much closer at the underwriters' numbers. Because the banks that actually helped take this company public, they aren't buying Musk's timeline.
Not at all.
Goldman Sachs is projecting $470 billion in total revenue by 2030. Morgan Stanley says $330 billion. That is a massive chasm of difference between the CEO's forecast and the underwriting banks. Is Musk's math practical at all?
Well, it requires an almost impossible growth curve. To hit the $1.1 trillion revenue mark that some of the more aggressive valuation models require by 2035, SpaceX would need to add roughly $360 billion in completely new revenue in a single year between 2034 and 2035.
Wait, $360 billion in 1 year?
In 1 year. If we look at corporate history, it took Amazon the last 6 full years combined to add that much revenue to its top line.
That's insane.
Yeah, SpaceX basically has to replicate Amazon's multi-year growth explosion annually.
And while they're trying to figure out how to cool data centers in a vacuum and, replicate Amazon's growth curve, we should probably look in what is actually generating cash right now. Because the AI dream is still mostly on paper.
Right.
Today, the core revenue driver actually keeping the lights on is Starlink.
Yeah, Starlink is the immediate commercial reality. Last year, the satellite internet division brought in $11.4 billion, boasting around 10.3 million global subscribers.
Which is an undeniable technical achievement.
It is, but there is a really concerning metric hiding in those Starlink numbers that impacts the profitability timeline, which is the average revenue per user, or ARPU.
Right, I noticed that in the filings. The total subscriber count is climbing, but the ARPU is steadily declining. Why is that happening if the network is getting bigger?
It really comes down to market saturation and physical bandwidth. The early adopters of Starlink were often rural customers in high-income nations, places like the United States, Canada, and Australia.
People who are willing to pay premium prices for high-speed access.
Exactly. But there is a physical limit to how much bandwidth a constellation of satellites can beam down to a specific geographic cell. Once those high-income markets reach capacity, growth has to come from expanding into lower-density, lower-income global markets.
Places across South America, Africa, and parts of Asia.
Right.
And to capture those markets, they have to dramatically lower the monthly subscription price.
Exactly. You just can't charge $120 a month in a market where the average monthly income is significantly lower. So the hardware costs to manufacture and launch the satellites remain incredibly high, but the revenue generated per new user is shrinking.
And that puts immense pressure on their operating profit margins, especially at a time when Wall Street is demanding exponential profit growth just to justify the $2 trillion valuation.
Yeah, it's a very tightrope to walk.
And that gap between a $4.9 billion current net loss and the trillion-dollar projections, it's starting to look like a bit of a minefield, which naturally brings us to the bear case.
The 38 pages of risk factors.
Yes. Reading through the S1 filing, SpaceX's own lawyers laid out 38 pages dedicated entirely to risk factors. And the single most prominent risk mentioned isn't orbital mechanics or Russian anti-satellite weapons, or even supply chain shortages.
No, it's not.
The number one risk factor they warn potential investors about is the CEO himself.
It is so rare to see a prospectus flag its own leadership as a primary operational hazard, but, the circumstances here really demand it.
How so?
Well, the filing explicitly highlights Elon Musk's divided attention. He is actively running or heavily involved in Tesla, Neuralink, the Boring Company, and X. Wall Street usually demands intense, singular focus from a CEO navigating an IPO of this magnitude.
Right. And the risk isn't just about his time management, is it? It's about how the company's stock is legally structured. I was looking at the voting rights established in the S1, and it feels like retail investors are basically buying a ticket to sit in the passenger seat with absolutely no access to the steering wheel.
That is the reality of dual-class stock structures. They've become increasingly popular in Silicon Valley, but it's taken to an extreme here. The IPO was structured with Class B shares that carry 10-to-1 voting rights.
Meaning what, mathematically?
Mathematically, it means that post-IPO, Elon Musk personally holds 82.4% of the total voting power.
Wow. So even if major institutional investors or activist shareholders buy billions of dollars in stock and decide the company needs to pivot its strategy, they have absolutely zero legal mechanism to force a change.
None. Musk has total unchecked control over a $2 trillion public entity.
And that concentration of power has to be alarming to fundamental analysts, especially when you look at how aggressively cash is being funneled into the most experimental divisions.
Oh, absolutely. Let's just look at the financials for the AI segment. In 2025, that unit generated $3.2 billion in revenue, which sounds promising on the surface,
Right.
but it lost $6.36 billion in the process. More critically, it consumed $7.7 billion out of their $10.11 billion in total capital expenditures for the first quarter.
Wait, let me get that straight. So of the massive amount of money they're spending on physical infrastructure, the rockets, the launch pads, the actual metal and fuel, almost 75% of it is being incinerated by the AI division.
Yes, an AI division which, by the way, is heavily reliant on a rocket that isn't even fully operational yet.
Right, Starship.
That is the ultimate bottleneck. CFRA analyst Keith Snyder pointed out in his notes that the entire $2 trillion valuation basically collapses without Starship.
Because the Falcon 9 isn't big enough.
Right. The Falcon 9 rocket is an incredible workhorse, but it physically cannot lift the sheer mass of the next-generation Starlink satellites. And it certainly cannot lift thousands of heavy AI data center nodes into orbit.
So Starship is the only vehicle capable of doing this. And so far, Starship's development has included several of what SpaceX cheerfully calls rapid unscheduled disassemblies.
Explosion.
Right, explosions. If Starship suffers a massive setback, Or if the orbital refueling mechanism proves too difficult to master, the entire deployment schedule for the AI data centers gets pushed back by years.
Which would trigger a catastrophic repricing of the stock. And, this brings us to the macro risks.
The IPO curse.
Exactly. When a company hits a $2 trillion valuation, it ceases to be just a business. It becomes a cultural and economic lightning rod. We frequently see this IPO curse, where the transition from a private, closely held company to a highly visible public entity puts a massive target on your back.
We're already seeing that play out, actually. The sheer scale of the wealth generated by this IPO has drawn intense political fire from all sides of the spectrum.
Yeah, it's unavoidable.
You have figures like Bernie Sanders and Gavin Newsom publicly pointing to this event as the ultimate symbol of wealth inequality. They're highlighting the friction of everyday citizens struggling with inflation, while a single public offering generates unprecedented trillionaire wealth.
Right.
And just to present the facts impartially here for our listeners, the cultural reality is that SpaceX is now operating under a microscope. As a private company, they could brush off a lot of regulatory pressure. But as a $2 trillion public giant, every launch failure, every labor dispute, and every government contract is subject to congressional hearings and intense public scrutiny.
The regulatory landscape shifts completely, and that cultural friction, it feeds directly into the danger for the retail investors who are currently driving the stock price.
Because it's mostly a retail frenzy right now, right?
Exactly. The market is witnessing a massive retail frenzy. But historically, when retail capital floods into a stock at unprecedented valuations without the foundational support of fundamental earnings, the eventual correction is violent.
Let's talk about those historical parallels, because they really illustrate what happens when the floor drops out.
Well, you can look at the dot-com crash, where companies with massive revenue projections but zero profits drove the NASDAQ up, only for it to eventually collapse by 78%.
Right. Or GameStop.
Yeah. We saw the mechanics of retail frenzy with the GameStop short squeeze, which crashed 90% after the peak. You can even look at the 2008 housing bubble or the 2017 Bitcoin boom.
The mechanism is always the same.
Always. When a valuation completely detaches from current earnings, there is no structural floor to catch the stock when the narrative changes.
Because with a normal stock, if you're buying an Apple or a Microsoft and the stock drops, eventually the dividend yield and the price-to-earnings ratio become so attractive that value investors step in and buy, stopping the bleeding.
Exactly. But SpaceX doesn't have those safety nets. If the growth narrative falters, there is no mathematical reason for value investors to step in.
Morningstar actually published a deep dive analysis that puts a very specific number on that danger. They ran the models and valued the actual fair price of SpaceX based on realistic growth and current fundamentals at just $63 a share.
Wow.
Yeah, that is a 53% discount to the $135 IPO price. But on the first day of trading, the stock closed around $161.
So the gap between $63 and $161 is entirely speculative premium.
Right. If Morningstar is accurate, buying at $161 means you are essentially paying a $98 option premium.
That's huge.
You're paying nearly $100 extra per share purely for the unrefundable lottery ticket that Elon Musk successfully figures out thermodynamics in a vacuum, completely dominates space-based AI, and scales Starship perfectly. What happens to the thousands of retail investors holding the bag if the company misses a single quarterly growth target and that $98 premium just evaporates?
That is the harsh reality of valuation compression. If SpaceX reports a quarter where Starship development stalls, or the AI data centers prove too heavy or hot to operate economically, the market's faith evaporates.
And the bottom falls out.
Because there's no fundamental profit floor to catch it, massive amounts of retail wealth could be wiped out in a matter of days.
So we have thoroughly unpacked the mechanics of the starry-eyed bull case, projecting trillions in orbital AI revenue. And we've grounded ourselves in the bear case, anchored by cash burn, unchecked voting power, and historical valuation bubbles.
Right.
Let's synthesize the raw data for the listener. Looking at everything we've covered, what are the specific milestones that must be hit over the next 5 years for this $2 trillion bet to survive?
It requires flawless execution on 3 distinct engineering and economic fronts. First, the bottleneck. Starship must scale.
Right, the rockets.
It has to fly reliably, frequently, and without massive loss of hardware to drastically reduce the cost of payload delivery.
Right.
Without cheap, heavy lift access to orbit, the infrastructure model is physically impossible.
Okay, that's one.
Second, the current cash engine, Starlink. They must find a way to expand their operating profit margins. They have to overcome that declining average revenue per user by innovating the manufacturing side.
Meaning driving down the cost of the satellites and the ground terminals fast enough to remain profitable in lower-income global markets.
Exactly. And the third hurdle is the multi-trillion-dollar wild card, the AI. Those wildly expensive orbital AI data centers have to translate from a brilliant whiteboard concept into a commercial reality.
They have to solve the thermal radiation problem, the giant thermos.
Yes, the giant thermos in a vacuum. And they have to prove that beaming compute power from space actually provides a tangible cost or latency advantage over just building a traditional data center next to a nuclear plant in Texas or Iceland.
Because if it doesn't,
That is the ultimate test. The engineering miracles have to translate into undeniable economic advantages. If it costs more to operate in space than on Earth, the whole enterprise fails.
it is just a massive stack of ifs. But as we wrap up this deep dive, it raises an overarching question about the entire landscape of global technology. Because we've spent all this time scrutinizing the balance sheets and the physics to see if SpaceX can actually pull this off.
Yeah.
But I want to leave you with a thought to consider long after we sign off. What if they do? If SpaceX successfully overcomes the heat dissipation, scales the rockets, and builds the foundational monopoly layer infrastructure for global internet and artificial intelligence from space, what happens to the terrestrial tech monopolies of today?
That's the real question.
If the future of compute is in orbit, will the Silicon Valley giants we currently consider absolutely untouchable, the Googles, the Amazons, the Microsofts, simply become renters on Elon Musk's orbital infrastructure tomorrow?